Steve Cucchiaro, after a 35-year bond bull market, are bonds now the least safe asset in people's portfolios?
Well, people have been conditioned to think of them as the most safe asset because during this bond bull market, people have not only appreciated getting interest income, but they've benefited from the capital appreciation as interest rates come down. We think we're finally at the end of this 35-year bond bull market. So what does that mean? That means that now investors have very little investment income, especially against inflation, and the potential is for capital depreciation. So we think that bonds are a lot less safe than people have been conditioned for the last 35 years.
And there's a lot of different types of bonds. So which bonds are most at risk? Is it the high yield? Is it treasuries, perhaps? TIPS? What is it?
Ironically, we think the bonds that are at the most risk are long-term treasuries in the safer bonds because those interest rates have come down so far. Worldwide, you can say that interest rates at the long end are at historic lows. We've never seen such low yields. There's not much more they can go down. There's a lot more over time that they can go up. So we think that that's where the risk is.
And once again, you're not talking about default risk. You're just talking about, because if you hold these things all the way through, you're not going to lose your money.
That's right. You'll keep your money, but maybe lose money against inflation. Inflation might grow faster than the income from your bonds.
All right. Speaking of losing money, what is your view about European, German, and Japanese bonds? Because if you do invest in those, you will lose your money.
That's
Negative
right.
interest rates.
That's right. In trying to grow their economies, they went so far as to create negative interest rates. So people buying those bonds are guaranteed to lose money if they hold to maturity, and even more if the bond yields start to go positive again. So we certainly stay away from those areas. The only people that are buying those in big quantities are the central banks trying to create a growth in their economies.
And what about emerging market bonds? Because people are looking for yield, and one place where they can traditionally find it is in emerging market bonds. However, emerging market bonds tend to get hurt when the Fed raises rates, which could be coming fairly soon.
That's true. So some people have done very well by migrating to emerging market bonds where they get higher yields. But like you said, if the dollar begins to strengthen after, say, the next rate hike, which could be in December, then the currencies of those emerging market bonds will start to fall, and people might lose more from the currency change than they might make from the yield gain. So we would be cautious there.
All right, so let's put it all together. Say you're looking at a diversified bond portfolio right now, and you own everything. You own emerging, you own developed bonds, you own munis, you own high yield. What should you do?
First of all, we say stick to the U.S. If the dollar strengthens, that could hurt the other bond markets. And then secondly, position yourself for a rise in long-term yields, which means either buying TIPS or Treasury inflation-protected securities, since the bond market is building in such a low forecast for inflation. It's like buying insurance when insurance is very cheap, or get to the very low end. And so we like some of the ultra short-term bond funds that are taking advantage of the rise in the LIBOR rate. So you're getting more than a money market fund, but still at a very low maturity.
All right, well, thanks a lot for coming on and talking about it, Steve.
Thank you.
And thank you for watching The Street.